Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. You know what I do if you've watched this show for a while or heard on the radio. What I do on the show, All Things Financial, is try to mirror some of the circumstances that I see come up in my practice and share with all of you listeners and viewers some of the problems you may not have anticipated that other people walking your same path are going through or have already gone through in the past, how to sometimes avoid those situations. Sometimes we get good cases where there are some successes and we want to learn how to repeat those same circumstances or put ourselves in those situations. And then other times we find there are problems that we have found solutions to, or problems that we have found ways to either prevent, avoid, or manage through them if we can prepare or predict that they might happen to us far enough in advance we could prepare. So what I do in this series is try to uncover tax saving opportunities, different protection opportunities, how to save money better, be more efficient with whatever you have. And currently we are on an ongoing mini-series with Ian George, a special guest of mine who we do quite a lot of work with. Ian, I'd like to welcome you back on this show and say thank you.
It's a pleasure to be here.
Ian is sharing with us a lot of the information that pertains directly to protecting assets through life insurance, long-term care insurance, and some insurance type vehicles that if those circumstances happen to us, the problems might be catastrophic. And it's better to transfer that risk in some cases to an insurance company or outside party to bear that risk because we couldn't afford that risk on our own. So we've been talking about how to program needs. And when I get through retirement planning and into the stages with couples or business owners, the biggest area that I see that is a total retirement killer, that I have the greatest difficulty in finding solutions or acceptable solutions or affordable solutions, is if one of the spouses in retirement or a family member goes into a nursing home or needs nursing home care and the children want to keep them at home. In any case, if they need nursing home care or nursing home type of care, and this extends to all of you sons and daughters listening, it can devastate your lives if one of your parents needs to go into a nursing home or needs that type of care, and you don't think it will, but for love for your parents, I see a lot of kids, one of the spouses quitting work, causing financial hardship to themselves, going down to one income now, and having the additional expenses of trying to help provide for mom and dad and be a caregiver. So Ian, I'll turn this over to you to help share some of your options on what have been successful solutions for some of your clients too.
Okay. I think that probably the best place to start is a little bit of a history about where long-term care insurance itself started, and then kind of, bring you up to speed as to where we are today. So, a number of years ago, and I'm going to go back 30, 40 years actually, the first long-term care insurance policies came on the books. At the time, the very first policies weren't really, to be honest, all that great. They conflicted a lot with health insurance of when one carrier would pay and another carrier would pay. And that also becomes a big concern, and I'll get to that shortly too, so we know what we're talking about in terms of the differences. But in 1988, the federal government got involved in terms of regulating long-term care insurance, and that helped to legitimize the contracts dramatically, basically drawing a line as to what it pays for and what health insurance pays for. So let's review that. So because I will tell you that when we sit down with clients, the first question we get when long-term care insurance comes up, or more importantly, forget the insurance portion, long-term care comes up. the big question comes up to, what is that exactly? How does it look? So a lot of people automatically understand a nursing facility. If you're in a nursing facility, you're in a long-term care setting. And a lot of people understand that. Although the question has become a little bit more complicated today, because actually getting a place to stay in a long-term care facility today would be quite the trick. So if somebody is counting on, oh, I'll just go into a long-term care facility, that's not that easy to do anymore. Okay. So let's talk about where your health insurance ends and where the long-term care begins, and where you would want long-term care insurance to begin at that point.
Okay.
So health insurance that we're all used to, and this doesn't matter if it's the health insurance that's provided to you by your employer, through one of the major carriers, or if it's your Medicare and a Medicare supplement plan, or other plans that work within the Medicare type planning. So basically, those are all health insurance. They fall under that great heading. And health insurance is designed to treat something that's acute. So an illness comes on, I wasn't sick, I am sick now, and more importantly, I'm on the road to recovery. So I'm going through treatments, I'm being treated for my ailment by a doctor, a nurse, I have prescription drugs, I have everything else that I'm going through. I could have, rehabilitation that's a part of what I'm doing, but I'm actively under a doctor's care. Where that ends and where long-term care begins is when people have basically tabled. So for example, if I lose my ability to walk due to old age or a catastrophic injury even, or something along those lines, there's a point at which time the doctors have done basically all they can, but that individual is not going to walk. So they're going to be confined to a wheelchair for the rest of their lives. Now, they no longer are being treated in that area for that ailment. They may be treated for other things that could certainly come along. If somebody's in a wheelchair, they could still, get the flu. They could still have a number of other things that go on. So of course they would be cared for under their health insurance for that sort of thing. But as far as losing mobility, there's no treatment for that. So, and actually mobility is one of the activities of daily living that long-term care can help pick up. So basically, that's one of the areas that comes in. That's where you are no longer recovering, you've plateaued.
Okay.
Now, a big area in this, and the largest trigger for long-term care, is cognitive impairment. And what that is when somebody, we know about Alzheimer's. People talk about Alzheimer's all the time and things like that. But it doesn't have to be specifically Alzheimer's. It could be a cognitive impairment where basically the family, and most importantly the family doctor, takes a look and says, look, it's not safe for mom or dad to be alone.
Okay.
So there's nothing acute there. There's nothing a medical doctor is going to step in and say, well, we'll cure that right away. Now, actually, the good news would be is if that was a situation where the cognitive impairment could be cured, obviously that wouldn't be long-term care. The medical doctors are going to take care of that, and you're going to recover. But more times than not, we're talking about something that's degenerative. Okay. Over time, somebody's reached a point where basically they're just starting to lose pieces of their faculties and things that come along.
Mental faculties.
Correct.
Sometimes physical. Okay.
Yes, physical can be a part of that as well. So what happens is that is where the long-term care world begins. So when the health insurance stops treating that given situation, and you're into a long-term care type need. And a lot of times, years and years ago, people would oftentimes, it would be the debate, how long can we take care of mom and dad at home before it becomes too much, and now mom and dad have to go to a nursing home. And always a very tough decision for all families regardless. But as I mentioned, nowadays, even a tougher discussion, because you might not be able to get mom or dad into a long-term care facility. Mm-hmm. So this is where long-term care insurance starts to become, really critical. Now, when long-term care insurance first began, basically the template was pretty straightforward. And what that was you would take a look at the situation and you would do an estimate. So here's what I'm going to do. I'm going to take a look at my first variable, which is my cost per care, my daily cost of care, and I would buy it by my daily amount.
You mean cost of care maybe in a facility or whatever?
It might be a facility. You might be calculating what it would cost for home care and things like that. So a lot of people would come up with a number that would be $150 a day or $200 a day. And that would be in today's dollars, taking a look at the situation, what it looks like today. Then on top of that, what you would do is try and figure out on the next calculation, which would be, how long do I feel I need this to last? Do I need this to last 3 years? Well, there are a lot of calculations that went around, and there were a lot of people quoting statistics that the average stay in a nursing facility was about 3 years or so. It's interesting because that didn't account for any of the care that somebody was qualified to receive prior to that. But, that's okay. People need to arrive at a decision. So you have your daily benefit amount and then your length of care. Is it going to be 3 years, 4 years, 5 years, things along those lines? So those were your two major factors. The next factor that came into play is an inflation protection. And this became rather important because if I'm calculating something today, and I'm based on if I needed the care today, to make that relevant 20 years down the road, I probably am going to need it to grow. And so most contracts today offer the opportunity, and they have for years, to add inflation protection, which is either compounding at 3% or at 5%.
Okay.
And there's some other, depending upon the carrier, they've come up with different ways of how they would calculate that.
And you're looking at that to help keep pace with what you expect the cost increases might be over time.
Correct. So as inflation increases the cost of receiving long-term care, my policy is increasing in value to cover the cost of long-term care. So now this always comes down to the big conversation of what does this shake out to be in premium cost. So that's where all these variables start to come into play.
Well, that's easy because all my clients tell me it's too expensive.
There you go. And long-term care insurance is not inexpensive.
It's very expensive until you lose everything you have because you didn't buy it.
This is true. It's like a lot of things. People talk about attorneys that way too. Nobody likes attorneys right up until they need one.
Right.
So, but long-term care can be daunting. So, and there's another factor that has changed the way long-term carers work too. So, what has happened is you've had all these different variables to build your own long-term care policy to try and be as sensitive to premium as to the value of the contract, what it'll provide for you over time. So striking that balance is where we spend a lot of our time with clients. Now, starting about 10 years ago, we had a new concept come on the market. And basically what that was is something that we've discussed here before, which is I have a permanent life insurance policy and I'm allowed to access the death benefit for long-term care.
Right.
Now, where a lot of that came from, basically came from the fact that there's a caveat. There's two areas of long-term care there are two issues with long-term care insurance. One is pretty valid. One, I'm not so sure it totally is valid, but I'll leave that to you and the viewers and listeners to decide for themselves. The first one, though, is you can't guarantee premiums. Long-term care insurance premiums cannot be guaranteed.
Okay.
That's put forth by the states, not just the state of Pennsylvania, but you can't go to any state in the union and buy a long-term care policy with a guaranteed premium.
Okay.
The insurance commissioners basically said, no, we're not going to allow that to happen because what they always were afraid of is that if the cost became too great, that the insurance companies would essentially fold, or at least fold that product, as opposed to passing on increase so that people could at least maintain some protection.
Okay.
So that's one of the big ones that people have gone through. And as a matter of fact, there was an article in the newspaper, in the local newspaper, in the last couple of weeks that talked about some major carriers again passing on premium increases. Mm-hmm. And there are some carriers, to be sure, today who have not passed on, haven't had any premium increases on existing policyholders. But that's something, again, this is definitely an area where having an advisor makes all the difference in the world. Doing this on your own could get very difficult very quickly. So the other aspect, though, where the life insurance concept became kind of popular was the fact that long-term care insurance contracts were use it or lose it. So if I paid for this long-term care insurance contract and my wife and I died having never used our long-term care insurance, that money was gone. All the premiums we had spent on that were gone.
Right.
Now, this is something that I think is an interesting argument, but again, I leave that to each individual to struggle with on their own as to how they feel about it. But I do think it's funny that when covering a risk, there are a lot of risks where if we don't use it, we lose it. And quite honestly, with most contracts like this, which I call pure peril policies, basically, when we talk about permanent life insurance, we talk about the living benefits, the cash value you can use and how it can become a financial piece of your overall asset puzzle and different things like that. There are insurance products that are pure insurance that we don't think of in that light. Term life insurance is one of them. Term life insurance has no cash value. I pay my premium. If God forbid something were to happen to me, my family gets the death benefit. Right. But most term policies do not pay a death benefit. As a matter of fact, the last study that I saw had upward, it was greater than 90% of term life insurance policies do not pay a death claim.
How do they get out of paying a death claim?
Well, because people have gotten rid of the policies before then.
Oh.
So, and that's why term life insurance, by the way, is so inexpensive. It's not really designed.
So that's user error.
Well, they lived.
They can't, but they canceled their policy, didn't let it run to maturity, or they outlived their policy.
They outlived it. Which, by the way, is the design of term life insurance. Term life insurance is designed to be a catastrophic form of life insurance. Permanent life insurance, obviously, is designed to be there when you die, which is why there's a huge premium difference. Term life insurance has a very low premium because the odds of you using it are very low. It doesn't mean it's any less valuable for something for you to have to protect your family, because if something were to happen, you would definitely want it to be there, and it does its job very well. So, but the other areas that we look at is I look at people with homeowners insurance. I have homeowners insurance. I would very much appreciate never using my homeowners policy.
And still paying for it.
Absolutely. Auto insurance almost counts, but it doesn't quite count because unless you pay cash for your car, the bank is going to require you to carry the auto insurance. Okay. And the same is true for homeowners if you have a mortgage. But there are a lot of families that have paid off their homes that still maintain their homeowners insurance. And they should. But the odds of their house burning to the ground compared to the odds of them needing long-term care are dramatically different. Your odds of your house burning to the ground are very low. The odds of you needing long-term care are very high. So the people who would never consider long-term care because it's use it or lose it, but would never do without homeowners insurance, it's just an interesting way to split it. I would even argue that the other policy that I would love to never use is my health insurance.
Yes.
But we all know we're probably going to use our health insurance, especially in this day and age. So that's where the life insurance chassis came up with, because what people were able to look at was to say, I can have this life insurance policy where I'm paying this premium, it has a death benefit, and if I don't use the long-term care, upon my death, my family's getting the death benefit. So somebody got something from the premiums that I paid in.
Okay. That makes sense.
Yes. And now, what a lot of people will notice, too, is that the difference between the price of a long-term care policy and the price of getting that same protection provided by a long-term care policy in a life insurance policy, the premiums for the life insurance policy are going to be dramatically higher.
Okay.
Usually by a multiple of 4 or 5.
Okay.
So if I'm trying to, I buy a $150 a day, long-term care benefit with a 3 or 4 year, benefit period, and it's got, 3% compounding inflation, which means in 20 years it's double, roughly. That huge benefit that it's providing to match that in a permanent life insurance contract is going to be a bit more expensive.
Okay.
So that really depends on what people want to do and where they feel comfortable. The next generation that came out in that life insurance area was the policies that are heavily focused. They're life insurance policies, but they're heavily focused on the long-term care aspect. And we talked about these the last time we spoke. We did, that was the gist of the segment, as a matter of fact. So that's come around too. The other area that's come about in this area are annuities. There are annuity contracts where people can put their lump sum of money. They have their rate of return that's declared by the insurance company, the interest rate that the insurance company is going to give you.
Right.
And then the insurance company will also add either a higher rate or a different type of payout that's a little bit richer than your traditional annuity payout if the money for that annuity, in that annuity, is used for long-term care.
Okay.
So now, what's interesting, and now you can start to see, if I have a concern about long-term care, my options have become many in terms of how I'm going to tackle this. And it may be one of these, and it may be a combination of all of them. But what I would say to individuals who are taking a look at this risk is the first thing that you want to do is talk to an advisor, because the first thing you want to do is start with a plan. What's my long-term care plan? Never mind how I'm going to pay for it. That's the insurance companies and what we talked about. But the first thing is the plan. Do I plan on trying to stay at home? Do I live in a place where that's even practical? I think of row houses in the South Side, where you walk in the door and immediately there's a ladder that goes right up. That might not be a great place to plan to spend the rest of your life if you need long-term care, unless you're going to have something, put in there into those places. Or have we moved to a ranch house and different things along those lines, because we would really like to stay at home for as long as we can. If I would prefer to take a look at long-term care, a long-term care facility, is the best way for me to secure that a transitional facility. These are the facilities that start with independent living, and then have a transition where you can go to assisted living or to nursing care. Mm-hmm. In that particular scenario, you've actually secured your bed for the next phase.
I see.
If that's something you want to do too. So once you have an idea of the plan for what you want to do to take care of yourself, then you sit down and you can start working with your advisor on all the different options. Is it going to be traditional long-term care insurance? Is it going to be one of the life insurance contracts? Is it going to be an annuity? Out of all of these, how much am I going to self-insure? How much should I always make sure in the back of my mind that I have a little bit set aside just in case that's what I need to protect me?
Yeah, not only you have to think of the spouses.
Correct.
Yeah. That makes a lot of sense. Folks, that's the one thing I don't see being practiced is what you just said, establish a plan, a long-term care plan first. I've not heard it referred to that way. That makes all the sense in the world. Then go out and try to talk to a specialist that handles all of the different areas, not a specialist that handles just one of the areas, and evaluate each of your own personal situations. Ian, I appreciate your coming on the show and sharing that with us very much.
My pleasure.
Again, I'll tell you folks, long-term care, the risk of long-term care, wiping out a family, wiping out a family's whole history of savings, a lifetime of earnings. This area in long-term care, it really is the retirement killer in my opinion. If your number comes up, there goes all your money and money for your spouse at a risk. You might be visiting attorneys. You might be panicking. But I'll tell you, this one area, get in to see us. We will help you develop a long-term care plan, and then we will help you be educated on all the different avenues of how to protect yourselves should this event ever happen to you. All right, folks, thanks again for tuning in to another edition of All Things Financial. We'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.